Hi, everybody. Sean McCracken from Hotel News Now here with Joseph Bojanowski, President and CEO of PM Hotel Group. How you doing, Joseph?
Good, Sean. Great to be here with you this afternoon.
Oh, I'm super happy to be here. So, PM, refresh my memory. How big is your portfolio at this point?
PM Hotel Group has about 70 hotels, a little under 70 that are open, with another 8 that are in development, various stages of construction. And so mid 70s in about 19 states, so across the U.S. and across all chain scales.
So 70 hotels is a lot of people. I want to just start by asking, it's there's a lot of talk about interest rates. There's a lot of talk about bringing standards. A lot of talk about a lot of things at this conference, but I want to check in on the labor environment and whether you think that's shifting for the benefit, for the worse. Where are you guys at in trying to fill all your jobs?
Yeah, I think we're more fortunate than some in that because of that size and scale that we have, we're able to provide a lot of opportunity.
Yeah.
However, because it is only 70-ish hotels, that we're more personal and have relationships with our associates. So our tenure is long, our turnover is low, but despite that, we still have a lot of open positions. We're here at NYU. We heard earlier today from HLA that there are over 200,000 open positions in our hotels today, and we're not immune to that. So it is driving new and better ways of looking and different ways of looking at how we deliver service that a customer values, and then but it's also continuing to drive wage inflation pressure. So the big hits have come over the last couple of years, over the 30-40% range, but we're still seeing it, and it's still causing pressure on the P&Ls and NOI.
So are you seeing the same trends on the F&B side? Is it any better? Is it any worse than the hotel operation side?
It's a little market by market, but I'll start with across the board. Culinary is a challenge.
Yeah.
So finding cooks, finding sous chefs. There was and arguably, rightfully, a exodus from that. We essentially closed every restaurant in the entire country, and that caused people to go find other jobs and other careers, and they haven't come back. So that's a problem across the board, and then it's very locationally specific around other things. I think another key driver of that also is immigration policy or lack of immigration policy, right?
Yeah.
It's historically been a industry that provides entry-level positions for people, but rapid opportunity for growth. And we're not seeing that entry-level positions coming in, and it's a challenge.
Yeah. I mean, do you have any hope of an immigration solution to the labor problems in this industry, though? I mean, that seems a bit optimistic, right?
No, but not wholesale immigration policy change, but something closer to what it was pre-pandemic. And which we're okay with too, right? And it also seems counterintuitive that you would have asylum seekers that are legally in the country that aren't allowed to work and pay taxes and contribute, and that's a good source of employment for us. And we think that that's maybe a good opportunity to find entry-level positions, candidates for our positions.
Yeah, the interesting part about that is, as we sit here at the NYU conference recording this, yesterday they kicked off the conference with an economist presentation basically saying exactly that. In Illinois, where they've made a concerted effort to get the immigrants there into, contributing to the economy. It's been a huge boon, which people don't think of Illinois as a boom state these days, but I mean, if that's what it takes,
Yeah, in the middle of COVID, when they were busing immigrants out of Texas, we were like, we'll send buses down there and pick them up and deliver them to our hotels to actually work if we were able to. Literally, if we would have.
Yeah, if they can. If you'll let them do it. Yeah. And that's the thing. I mean, there's all sorts of political opinions on who immigrants are, but just to get to this country, these are pretty hardworking people by their very nature, and they didn't come here just for a free ride.
Family-oriented, just want to do a job, just want to offer a better life for themselves, but more importantly for their children.
Yeah. this is a complete tangent, but it makes me think of my very first job out of college. I worked in the Finger Lakes, which there's a million Cornell people in the hotel industry, so they're very familiar with that region. But I worked at a tiny little newspaper, and part of my job was covering Wayne County, New York, which is just on the southern shores of Lake Ontario to the east of Rochester. Mm-hmm. And it's the biggest apple growing region outside of Washington State, which most people don't know.
Which makes sense. Yeah.
Yeah.
From a climate perspective, yeah.
So there was a ton of migrant apple pickers there, and getting to know that community and the people who kind of got them there, like, it is a remarkably hard-working community to get to. You start your life somewhere in South America and you literally migrate your way up to North America just to work for wages that most of us would find to be a pittance.
Yeah, and this is a nation of immigrants. And
exactly. Yes.
My grandparents were immigrants, and worked out well for our family.
Yes, if you go back far enough, all of our grandparents are immigrants or great grandparents, whatever. So changing topics entirely. We're officially a week and a half into the summer travel season. What are you guys seeing across your portfolio? Is it coming in as strong as you had hoped?
No. In a single word, no. And it was interesting that Smith Travel has revised their forecast for the remainder of the year down in terms of RevPAR growth to 2%, and it's driven a lot by what happened in March and April. But what we're also seeing is that the mid-scale economy segments have gone negative, and that's because of the pressure on savings and interest rates on credit cards and other things that are affecting those outside of the upper middle to upper earners in the country. And so you've got domestic travel that's primarily driven by that segment of earner. And you've got the European traveler who is primarily in the upper earning quadrants of the country, and so they're still going because they have the means and to be able to go. But the domestic traveler, the ones that primarily stay domestic, are not traveling as much. So we're seeing a distinct flattening. Now, you can take back to 2019, where you had 10 years of leisure growth, and up until 2020, now we're still above those levels. So it's not a bad thing, but it's flattening, and it's flattening very, very quickly. And then again, those who have the means to leave the country will leave the country and travel internationally.
Yeah, and the strong dollar makes that all the more appealing.
Yeah. And interestingly, to that point, the counterpoint to that is that because of the strong dollar, it is lessening some of the foreign inbound travel because it's more expensive to come here, and whether it's from Asia or from Europe, and so that's dampening that recovery a little bit. It will come, but that's as attractive as it is to leave, it's as unattractive to come here.
Yeah, and the beauty of that is, just as you said, this is not a forever. Currency always fluctuates. It's not going to always be the way it is right now.
Yeah, exactly.
So, as somebody who, operates hotels, where are the growth opportunities for you right now, especially in kind of a muted transaction environment?
Yeah. So here's what we know, that RevPAR is still growing but decelerating. Expenses are continuing to grow, right? So there are a couple of paths to success, and pressures on the capital markets continue to impact our owners, whether it's everything from a cash trap to DSCR covenants and recapitalizations and all the other complexities on that side. But what we do know is that from an operating perspective, got to drive market share, got to aggressively go after the middle of the P&L to drive efficiencies and lower cost per occupied room, drive ADR and GOP margins. Good operators are able to do that. That ability provides opportunity for an owner to enhance the operating performance of their hotel, and by extension, the value of their hotel. So as they're heading to a recapitalization or refi or whatever the event is, that's an opportunity for them. And good operators will continue to be able to provide value. In my humble opinion, those that cannot deliver at that level will go away or be acquired. And so specifically to your question, I think that's where the opportunity is for an owner to select a different management company, to change management with transaction volume being low.
Yeah. You guys aren't just a hotel operator. Obviously, you're active on the development side. I'm curious, how is that side of the business these days? Because it's been kind of historically muted. Have the conditions there gotten any better? Obviously, interest rates are what interest rates are, but has the availability of lending gotten better? Has the availability of construction labor gotten any better?
Yeah, so what you see from the brands is record signings.
Yes.
However, there aren't record numbers of shovels going into the ground. And they're distinctly different things, and which also goes to the muted supply growth over the next 2 or 3 years, right, in the less than 1% range. But good owners with good projects are getting financed, and they're getting deals done.
Yeah.
And the leverage is a little lower, so the equity needs are a little bit higher. But those who have, again, good projects, well capitalized from an equity standpoint, and are in good markets with good brands, are getting deals done and are getting development done. We are fortunate to be aligned with a number of those kind of hotels. So we've got an owner. So we've got projects going in Austin, Texas, in Philadelphia, in the Lake Tahoe area, and some markets that are just robust from a demand side and have very little supply coming into them. Austin excluded from that supply side.
So are those generally getting money from relationship lenders? Is that?
Yeah, that's exactly right. It's easier to get the mid-sized deals done just because of the relationship lending, and lenders have to put money out, right? That's their business, and so they want to do it. They just are cautious, and it's a little more expensive. So you got to figure out a way to effectively build. And I think that brands have been contributing on that side to maybe a more compact model, something that's a little less cost to build on a per key basis, and so that those things combined are allowing deals to get done.
Yeah. And you guys kind of benefit on either way, right? Because if supply remained muted as operators, that's not the worst thing in the world, right?
Yeah, we are against supply where we have hotels. We're for supply where we don't, and against it once we get deals going. But yeah, I think that muted supply growth and continued demand growth is going to set up our industry in the U.S. for a pretty good run for the next 5 years. And I think the capital markets issues will work themselves out over the next year or so, and the defer PIPs and those kind of things. But I think we're set up for a pretty good 5-year run here.
Yeah, I mean, to that exact point, do you have to sometimes consciously zoom out in your mind so you're not worrying about interest rates, you're not worrying about the short-term issues, the summer's not as strong? There's all sorts of reasons to feel pessimistic. Like, do you have to consciously be like, what, in the grand sweep of things, it's pretty good?
Yeah, there's always been challenges, right, in our industry, and whatever it might be, but there's always a lot of positives too. And I think, as a management company with 3,500, 4,000 associates, we are always focused on keeping our associates engaged on what's most important, which is delivering an experience that garners preference and loyalty and repeat customers and all that. One of our key words this year is resilience. We just had our leadership conference a month ago in Dallas, and we had 350 of our leaders there, and we were very focused on resilience, and it's remain optimistic, but remain resilient. There's a lot. There's still. It's going to be choppy, and as an operator, with the keen focus on the middle of the P&L and what that brings, like, we just have to be resilient and it'll get better. And again, we have a good 5 years ahead of us.
Yeah. Before I let you go, I do want to know what's something specific that gets you excited about the industry or business right now, and what's something that maybe keeps you up a little bit at night? What's the one good thing and the one bad thing?
Wow. Couple of good things. One, as I mentioned previously, I think because of the supply and demand dynamics and the muted supply growth, I do think that we are in for a pretty good run over the next 5 years.
Yeah.
Interest rates, while they're higher than they were a few years ago, they're a lot lower than they have been for many, many decades.
Yeah,
right? So,
yeah.
so we'll work it out and that all flush out. But I think we're in a good place. I'm super excited about, despite the fact that we have 200,000 jobs opening, there are a lot of new people coming into our industry again, and it's great to see fresh faces, and it's great to see that energy that's coming in, and the challenge to our industry to maybe do things in a little bit different way. I'm excited about what technology will bring. I'm excited about the ability to be able to curate and customize a stay for every single guest.
Yeah.
And the value that drives, and that we can ultimately charge for and generate NOI for, and to see where we go with technology. It will always be a people business, but it'll be enhanced by technology.
Yeah, it feels like it's been years and years where we've talked about the potential of like that kind of ultra customization, and it seems like more than ever today, it seems like it's something that we could pull off as an industry.
Most other industries are doing it, and particularly when you look at retail and the way that they serve up highly customized offers for you, both from a pricing and a product perspective. We can do it in our industry. We will do it, and I think you'll see that that's coming in the next few years. You know, some of the major brands have big initiatives going on the technology side. So think attribute-based pricing and all the things that drive that customization.
Mm-hmm. Well, I really appreciate you taking the time to talk.
Thanks for inviting me. Pleasure being with you today.
Hi, I'm Isaac Colazo, Vice President of Analytics at STR.
Hi, and I'm Jan Freitag, National Director for Hospitality Analytics for the CoStar Group. Tune in to our new show, Tell Me More, a hospitality data podcast.
It's a podcast on the global hotel industry, its current trends, what we're thinking about, and where the industry's going.
And we like to have fun with the data too. Find us on hotelnewsnow.com or wherever you listen to podcasts. Subscribe today.
This episode of the Hotel News Now podcast was recorded on June 4th, 2024, and edited by me, Sean McCracken. Head to hotelnewsnow.com for the latest industry news every day.